opportunity at this wonderful thing called life. Thank you for the time that we have this morning and the opportunity to dive in once again to the subject of resource management in the attempts of just becoming uh, more and more faithful in our stewardship, the resources you entrust us with. So I ask this morning for your words to be spoken and for the most beneficial, edifying, and useful message to be received, whether or not that is the same words that I use. But Lord, we want to honor you and bless you with this time. Thank you so much. Amen. All right, week 5. Here we go. Woo! Investing part 2. And today we're talking about tactics. So we've moved through this 5-week journey so far, and next week is the last one, the 6th week, at least the last of the current cycle. We'll see about rebooting it or potentially expanding it. But we've gone from the beginning of looking at the biblical theology of finance and resource management, and then we progressed into the concept of budgeting, and with a very simple definition, defining a budget as telling our money where to go rather than wondering where our money went. And then we spent a little time in week 3 starting to dream big, thinking about the destination. And so we're using this journey metaphor that we've used so often around renovation, which is when you're going on a journey, the first thing you need to know is where you are. And so that's where the budgeting comes in to place, and being brutally honest with our own assessments of our resource management. Now, everything that we're speaking on here specifically, we're talking about finance, but again, this could be applied to any resource that we are managing, whether that's our time, our energy, our health, our relationships, our influence, our talent. So there's so many resources that we've been gifted. And going back to the parable of the talents, we see that the Lord has gifted each of us according to our ability. However, the promise that we see through the end of the parable is those who are faithful with little can be trusted to be faithful with much. And so as we are faithful and disciplined to progressively move in the direction we're trying to go, generally speaking, that's the direction we're going to be moving. The direction you're pointing and going is generally the direction you go. I know, profound insight. There you go. There's your psychology lesson for the day. The follow-up to it is whatever you're looking at tends to be what you see. There you go. Psychology 101 for free. So then the next thing when you're going on a journey, so you need to know where you are to begin, but then you also need to know where is it that you're wanting to go. And so that's what we talked about in week 3. Last week, we touched on a lot on the psychology of investing and starting to ask a lot of the what ifs, and again, reflecting on where am I currently? How is it that I view resource management? How is it that I view finances? And how is it that I view my approach to investing? And I won't rehash all of that now because you can go back and watch the previous link. We'll make sure that that's up and online and accessible. So then the last 2 elements of this journey metaphor, so you've got journey, or you've got a starting point, destination. In the middle, you've got route and vehicles, which is what we talk about. So the route you're going to take is how do you want to get there? And then the vehicles, what are you going to take to get there? And I love that we use this metaphor of vehicles because in the world of investing, they actually use the term vehicles for your different approaches. So if you say, hey, I'm going to use stocks and bonds, those are my investment vehicles, or I'm going to invest in real estate, that's my investment vehicle. So I love that that same terminology applies and goes right across the, it translates perfectly. So that's that introduction there. When we're going on a journey, we need to know where we are, and then we need to know where we're wanting to go. But once those have been established, we can set about developing a strategy for the route and the vehicle or vehicles we want to take to get there. So we're going to jump right into it, and we're going to talk about vehicles. We're going to talk about the 4 types of income. And this is my amalgamation and summary of what I've come across over lots of reading and such. You'll probably find variations, different terminology, different categories of these if you do a lot of your own reading and research, which I would encourage you to do. But these are the 4 categories that I would place them into. So the first one, your first blank, is earned income. earned income. So this is income that's produced by an exchange of your time and skills for someone else's money. And those are your blanks. Income produced by an exchange of your time and skills for someone else's money. And I just put some examples in there. I mean, this could be any profession at which you work, but I put some examples of some higher income earners, things like doctors, professional athletes, lawyers, musicians, artists, scholars, designers, architects. You could also put in there burger flippers, baristas, etc. So just fill in the blank with any kind of a occupation. The second one is going to be passive portfolio income. I tried to give you a nice long blank to fit that all in there. Passive portfolio income. And this is income that's produced by residual payments from your tangible and intangible holdings. So income that's produced by residual payments from your tangible and intangible holdings. And again, I just put some examples down there beneath it. So that could be things like royalties. Maybe you've recorded a song, and that's your intellectual property, and every time it gets downloaded or bought or sold, you get a residual payment from that. It could be off of a book. It could be off of interest payments. If you've got like a savings account and you're putting your money there, you're not really actively working to do anything, but the bank says, hey, we'll give you a little bit of a kickback for letting us hold that money for the time being. So that's residual. That could also be things when we start talking about stock dividends, when a company pays their shareholders for the privilege of being partial owners. Come on in, good to have you. That could also be, I'm glad you're here.
I have a question that gotten old. I really
No, that's fine.
Tangible?
Yes.
Intangible.
So tangible, think of it as like physical things that you would hold, versus intangible is more like ideas, sorry. So out of this list, things like I would say rental or lease payments. So if you own like investment property or rental properties, I would consider that a tangible asset versus something like a royalty or intellectual property, where it's kind of, you get these payments for ideas that you've created that produce value. So that would be an intangible. Great question. Rental lease agreements, IP residuals, dividends, licensing. Okay, so we touched on those. The next one then, right below passive portfolio income, is active portfolio income. And this is going to be income that's produced by the buying and selling of goods, collectibles, real estate, and other valuables. Active portfolio income. Income produced by the buying and selling of goods, collectibles, real estate, and other valuables. And this is the one that I think is what most folks probably instinctively gravitate towards or think about. So a lot of examples, I just, again, made a little sampling here. That could be things like art. A lot of people invest in art collections. They buy and sell them. You've got stocks, you've got options, commodities, futures, Forex, which is effectively foreign exchange or currency exchange, cryptocurrencies, buying and selling of properties, fix and flips, that could be land development, IPOs, which is initial public offerings, and then private placement offerings as well. You don't have to know what all of those are right now. These are just examples of what would fall in that category. And then the fourth type of income, down here at the bottom, sorry, this is a long one too, so you got a long blank, business/entrepreneur income. And yes, I did have to run that through spell check. Every time I write entrepreneur, I always spell it wrong. So business/entrepreneur, that is ENTREPRENEUR. Entrepreneur income. And preneur, yep. And this is income that is produced by building and owning or selling a business. Income produced by building and owning or selling a business. Now you're going to see, you might say, hey, I feel like there's a lot of correlation between that and the active portfolio because maybe you're holding a business in your portfolio and you're actively working on it. So there is a little bit of like a blurring of those lines, but the way that I distinguish business or entrepreneur income is it comes about from how can you build value in your investment. So in something like stocks, bonds, art, and collectibles, there's usually not a lot that you can do personally to influence the valuation of it. You're more hoping to be wise and shrewd up front in your selections and then wise and shrewd in the selling. Your buying and your selling is where most of your activity comes from. In a business, there's a lot that you can do to build value. So that could be building things like professional connections or vendor relationships, things like that. Intellectual property branding or marketing. You can build value with a brand or through a marketing strategy. You can build value through, I guess I already touched on that one. Oh, and I just put, small business, medium and big businesses. And then just an example, mines and quarries. But there's obviously a lot of types of businesses out there. But the idea is it's something that you build and either hold or sell over time. And that's the business/entrepreneurial income. All right, so the 4 types of income: earned income, passive portfolio income, active portfolio income, and business/entrepreneur income. All right, so we're going to set that over here for a second, and we're going to jump into another little subject that is very related, and that is going to be defining assets and liabilities. So these are a couple of big words that most everybody has probably come across at some point. And we're going to just touch on that a little bit here and come up with a shared definition that we can use for the purpose of today. So we got the line here with a couple of blanks, and I say many people fail to succeed in finance because they have failed to define what assets and liabilities are. And then they fail to distinguish one from the other. So many people fail to succeed in finance because they have failed to define what assets and liabilities are and then distinguish one from the other. So you'll see down below here, I'm actually going to give you 2 definitions of both asset and liability. The first one, I tried to be as close to the book or the dictionary definition as possible, slightly tailoring it to language that makes sense. And the second is more of a rule of thumb that I like to use, and use it if it's helpful, and if not, feel free to disregard it. So the first definition of asset, there's not even a blank there, it's just possession of a realized or potential cash value. And so again, that could be a stock certificate, that could be a rental home, that could be a licensing agreement or anything like that. So a possession of realized or potential cash value. The layperson's definition, go ahead and fill in the blanks here. An asset is something that puts money in your pocket. And that moves us to liability. So liability, one definition is it's an obligation or a debt equating to realized or potential cash value. So these are going to be things that will show up on your financial statements. Like, hey, we've got assets, I've got a car, I've got a house, I've got stocks, I've got liabilities, there's a mortgage, there's a loan, there's credit card debt, etc. So it's equating to a realized or potential cash value. But then going back to our layman's term, liability takes money out of your pocket. There's your blanks. It's a very simple definition, but to me, I feel like that's an easy way to filter through the world of opportunities and deals as they present themselves.
So is a house an asset or a liability? Oh, wow.
That's a great question.
Really?
So again, 2 philosophies. By the book definition, it's an asset. By my layman's definition, it's a liability. Now, unless it's a rental property where there's payments coming in, then in that case, it could be an asset.
And then
So,
once it's paid off, it's definitely, but,
oh, yeah.
so it can be both, it would be both when you have a mortgage.
I'll say if it's rental and you have payments that are coming in,
Or
then it would be an
me, the
asset.
homeowner, my home, I own my home. Well, I don't, but,
Right.
so if you have a mortgage, it's an asset and a liability?
So on your taxes, on your income statement, your balance sheet, it's going to show up as an asset because it holds value. It has a cash value to it. But for the working definition, it's not putting any money into your pocket. So it would be considered a liability in that regard. Mm-hmm. So a couple of other examples, like I'll say a stock that doesn't pay a dividend, and a lot of people are going to disagree with me on this. I would actually consider a stock that doesn't pay a dividend to be a liability because it takes money out of your pocket to purchase it, but it doesn't give you anything in return other than the hope of appreciation. Versus if you have a stock with a dividend, or this isn't a great example, but say you have money in your bank account and they pay you interest, technically that would count as an asset because it is putting money into your pocket. Yeah, without you having to actively manage it. So, and that's my big disclaimer. I know that those are kind of competing definitions, but when we move forward into the next section, which is going to start being how do we start to evaluate and analyze potential opportunities, running it through this layman's term, I've found to be very helpful. Okay, if I'm looking at maybe purchasing an asset, is it something that's actually going to be producing income, or is it going to be taking money out of my pocket? In which case, maybe it actually is a liability. So it's just kind of a helpful, I guess we'll say, litmus test for deciphering that and filtering it. Great question. Hopefully that helped. I would consider, again, in most cases, a car is going to be a liability. Some people do ride sharing, Ubering, where it can be used as a way to produce an income. It's one of those kind of like necessary things, like obviously food, you have to eat. These days, most people have to drive, so you need it. I would consider it like an expense, but not really. In terms of investment, I wouldn't think of it as an asset, even though you would record it on your balance sheet as an asset. So we're going to briefly touch on Deuteronomy 28:12 again. We read that one last week. And this is cool. This is God speaking through Moses to the Israelites, and he says, "The Lord will open for you his good storehouse, the heavens, to give rain to your land in its season and to bless all the work of your hand. And you shall lend to many nations, but you shall not borrow." All right. So this brings us into another potentially controversial section when it comes to finance and assets and tactics. Is there such a thing as good debt? Most of the time we think about debt as being bad because it's going to be a liability. It takes money out of our pockets. However, there are some schools of thought that suggest, well, there is such a thing as good debt if you can procure financing, if you can receive a loan for a certain amount that would help you purchase an asset, and the loan payments, say, are $500 a month, but the asset's going to give you $700 a month. Well, even after you subtract the 500, you'd have a net positive of 200 a month. Many schools of thought would say, well, that's good debt because you're using it to effectively purchase an asset that's going to put more money in your pocket than it's taking out. So if we refer to that again, at least we've talked about it once. And then just the small little one right below that, what is leverage? So leverage, most of us know from school, it's using whatever you want to call it, a mechanic or some kind of engineered device that allows you to use less effort to achieve greater results. And so physically, you could talk about levers and pulleys. Hey, I normally can't lift 500 pounds, but if you give me, if the piano is sitting there with yay little small wedge of plank, and I've got 20 feet over here, and I can just do a quick little whoop, all of a sudden I can move this massive 500-pound piano relatively easily. So leverage in terms of financing is similar. And that's one of those areas where you can get into good debt. So for example, if you said, hey, I want to purchase a rental house or a fourplex or something like that, and I know that if I can get into it for X amount, and I know effectively what the payments would be, but the income from it would be net positive, well, you might have the opportunity to control a $500,000 property with only having to put $100,000 down. Or maybe if you're living in it, maybe with 3.5% down. Or if you're using a VA loan, maybe with 0 down. And so the idea is you can control $500,000 worth of asset without having to have $500,000 in your pocket. So that's the idea of leverage. It allows you to take something small and control something big. Okay, for 20% down, I can control 100% of the asset. Or for X amount down, I can control 100%. Or if you're doing a business deal, maybe it's not so cut and dry, but for 10%, you can control 40% of the company, however that works. So the idea of leverage is that it just allows you to use a smaller amount of effort, or in this case, lending or financing, in order to achieve greater control over the asset and its profitability, its direction, and so forth. So we'll come back to that again later. I use the example with real estate because that's probably the easiest one to explain. There's a lot of leverage that's available in the world of investing, and a lot of it's just more convoluted to explain. So, so we'll start with the easy one, which is real estate. Okay. Now we're going to dive in. You notice I'm kind of hitting a bunch of categories, and then we're going to weave them all together at the end. So the next one is types of assets. And you can see I've listed out 3 here. Again, there's other words, terminology for these. This is kind of my own stamp on everything I've absorbed. So the first of the 3 is what's called paper assets. Paper assets. So these are going to be things like stocks, bonds, ETFs, which is exchange traded funds, index funds, mutual funds, commodities, options, forex, annuities, insurance related things, master limited partnerships and trusts, and so forth. The only one on there that you can kind of say, hey, you're fudging it, is commodities. I still call it paper because nowadays you can effectively just have a piece of paper that expresses your ownership interest. You don't necessarily have to have a warehouse with 20 tons of corn, or or you don't have to own a part of an oil rig or anything like that. So you can actually just put it on paper as the ownership. That's why I put it in this section. But paper assets, those are ones that effectively you're never really going to have a physical, tangible something to represent it, at least in the modern era. You typically are just going to have something that's written down somewhere that documents your ownership interest. So that's paper assets. Second one is portfolio assets. And you can see, again, some examples of that. Things like royalties, intellectual property, that's the IP, licensing, that could be businesses that you own, or maybe like franchises that you receive payments on. That could also be entrepreneurial endeavors. So portfolio are things that they're still paper, but a lot of the times they are linked to either intellectual property or like businesses and things like that as well. And then the third one, real estate. Lots of types of real estate. Rental properties, multifamily housing, there's commercial real estate, lease options, tax liens and deeds, and then REITs, which is real estate investment trusts. I know that's whenever I use an acronym, I feel like I need to explain what it is because not everybody speaks acronyms as well as my brother-in-law, who is he's really good at acronyms. So 3 types of assets: paper, portfolio, and real estate. Okay, now we're going to get into some of the good stuff. This has all just been like getting definitions, getting us on the same page. Now we're going to spend a couple of minutes talking about how do we find, analyze, and select good deals. But first, let's go back and listen to some of the wisdom of one of the wealthiest entrepreneurs and investors of all time, a little man named Solomon. I guess he probably wasn't little. I don't know. I never met him. So a couple of verses here in Proverbs that'll actually be familiar. We've used them before. But the first one is Proverbs chapter 13, verse 4, and it says, "The soul of the sluggard craves and gets nothing, but the soul of the diligent is made fat." And so also in the previous chapter, verse 15, it says, "The way of a fool is right in his own eyes, but a wise man is he who listens to counsel." So what do we pull out of these? Hard work and being willing to learn and listen to those who have expertise. Those two lessons, if I would have paid attention to them, I could have saved myself a whole lot of bad learning mistakes. A very expensive education I've had. Go figure, it was in Proverbs all along. Some of those you read it, you're like, oh, that's cool. Well, anyway, I'm going to go do this. Like walking into a pole, like bong. Oh, I wonder what happened. Almost like somebody could have told me it was there, and they did, and I just didn't listen. Okay. So we're going to touch on three things that I think are integral to any form or approach to finding, analyzing, and selecting deals. The first one is what's called fundamental analysis. And very simply, fundamental analysis tells you what to buy. The other one that you'll hear in almost the same sentence every time is technical analysis. And technical analysis tells you when to buy and sell. So I'm going to give a couple examples of fundamental and technical analysis. And I'm going to really, really try to do my best to show how important it is to do your analyses for any deal, whether that's a simple stock transaction, whether that's purchasing a home, commercial property, whatever it is. Those who fail to exercise or practice or run their fundamental and technical analyses are the ones who usually or almost without fail are doomed to failure. Now, it is possible that you could still fail even through doing good analysis. However, you're mitigating that risk significantly. So the difference between somebody who analyzes potential deals versus one who doesn't, one who does no analysis is gambling. They're like, boom, put that money in that slot machine and let's see what happens. The one who analyzes can say, okay, I'm not playing slots because that's crazy, it's random. If you're going to use a casino metaphor, you might think of it like blackjack. Okay, well, I know there's actual numerical combinations. Maybe I can learn to count cards. I can keep track of what's going on where. I already know that they've played everything except for these two face cards. So that would be almost like a silly example of your analysis. So you're taking a lot of the guesswork, you're taking a lot of the random chance out of it to give yourself a more informed decision to make. But enough about casinos. Now we're going to use real life examples. Fundamental analysis, I'm just going to give you a couple examples of what that would look like with stocks and bonds, and then a couple examples of what that would look like with real estate. And feel free to write in the margins wherever you have. This is by no means comprehensive because there's a lot of things that you could analyze for a potential deal. The first one I want to touch on is stocks. But before we start analyzing stocks, I'm going to briefly explain what is a stock, because that's a word that we use a lot, and a lot of the times I think maybe we don't understand what it is. So a share of stock represents partial ownership in a company. Partial ownership in a company. And so when we think about stocks and how do we analyze them, a lot of people would just go straight on to Yahoo Finance or Google Finance or fill in the blank with a broker or Investopedia or any of these things. And they might just say, hey, what are the best 5 stocks to buy? And I hope somebody did the analysis for me. Oh dear. That'd be like, I don't know, what's a good example? I hope somebody fixed my car for me because, I didn't have time to. Oh, cross my finger. Oh, maybe that was a bad example to use, sorry. That's too perfect. So when you're analyzing a stock, it's actually best to analyze the company rather than just thinking of it as this arbitrary piece of paper. So for example, if I want to analyze Apple, like, hey, is this going to be a potentially a good stock to buy? Well, let me start with analyzing the company, Apple. Okay, how is its financial health? What are its prospects? What's its unique corner on the market? What's it doing better or worse than anybody else in its sector or its industry? Right? But the same thing if you're like, hey, there's this new startup company that's kind of doing the same thing. Okay, well, analyze them the same way. Okay, what is their competition? Do they have a unique edge in the market? Do they have something that they can use to produce value over and above these other players in the same industry? So thinking about it as an actual company rather than just, hey, their chart's been going up, that means buy because it's always going to go up. Slot machine. So again, we're trying to be a little bit more intentional about it. Now, when you're analyzing a company, and this is something I'm only briefly touching on it because it's a subject that we could honestly spend a lot of time working on and focusing on. And I would encourage us each to do so. Patty, you've got a leg up on the competition because of your knowledge of, we'll fix it, of stuff. But things like reading financial statements, reading income statements, uh, cash flow statements, balance sheets, things like that. Thank you. My sister's complimenting my shirt.
Yes, I like your shirt.
Well, thank you. So starting to familiarize ourselves with how to read a financial statement of a company and what are things to look for, indicators that the company is in good financial health. What are things that maybe would raise red flags to a financial statement looking unsavory? So a few examples that I'll use, and these are just 4 among a lot of indicators that you could use. When you're looking at a stock price, and you can find all this information through a financial statement, there's going to be what's called the price to earnings ratio, or the PE ratio. And what this is, you take the stock price and it's divided by the previous 12 months earnings per share. So if you say, hey, I got this stock at $100 a share, and over the last year it's produced, $5 per share of actual value in income and revenue. Okay, well then you just do the math. So 100 divided by 5, you would have a price to earnings ratio of 20. Now, there used to be great blanket statements of rules of thumb of what's a good price to earnings ratio. In the last several decades, that's become a little more difficult. So what I would suggest is when you're looking at individual companies, look in that same industry and specifically the same sector, and just try to get a sense of what's average, what's a normal price to earnings ratio for this sector. So if I'm looking at technologies, if I'm looking at Tesla and Apple and Google, and Nvidia, try to figure out what's a common price to earnings ratio for that sector, and then you can determine this particular stock, if that's high, if that's low. Just to give you a general rule of thumb, a higher price to earnings generally means that there's sentiment from shareholders, there's excitement, there's an ambition or a thought that this stock is going to continue moving upward at a pretty rapid pace, the higher the price to earnings is. However, the more established, the long-time runners, utility companies, Procter & Gamble, those ones are usually going to have a fairly low, proportionately, price to earnings ratio. They're not expected to have explosive growth, but there's kind of this expectation that they're going to be pretty steady and maybe on a very faint, upward trend. So what is the stock price in relation to the realized earnings of the past year? So that's a useful one. And again, just compare it against a relative sector. In technology, your baseline might be 20, 30, 40 is like an average. When you're looking at banks and those kinds of things, you might be more, 10, 15, loosely. So that just kind of gives you a ballpark. Theoretically. Right. Theoretically, the lower the price to earnings ratio, it should be less volatile. But again, you got to look at the sector and then just compare an individual and where it sits in relation to that. I mentioned earnings per share, so that's another one that's helpful. They list it out as EPS on all the reports. And that's effectively, that's just how much a company earns for each share of stock. Now that number, earnings per share, typically a higher number is better. So if I am buying a share of a stock for $100 and their earnings per share is like 5 cents, like, oh, okay, well, that's interesting. Versus if they're taking that money that I'm investing with them and they're producing something valuable with it, maybe the earnings per share is $5 or even $10. And to me, that's a positive sign because it shows that the company is being able to take my investment and do something with it. They're helping it to multiply and produce greater value. Where does financing for businesses come from? Basically, it comes from two places. It comes from what's called equity and then what's called debt. Equity, you think of in terms of ownership interest. So when I'm going into a business and I want to, like, if I'm starting a business myself, I have 100% equity interest. If I'm going in with a partner, we're splitting it 50-50. If you have a lot of people that retain some kind of ownership interest, the percentages can vary. But equity is effectively my own time, energy, effort, etc., that's going in to be used to build the business in exchange for ownership of that company. Debt, on the other hand, is loans, borrowed money, effectively, if you will. So all businesses, most businesses, are going to use both forms of financing. And depending on if it's a small, medium, or big business, how much debt / loans are they going to take versus how much equity, how much of the ownership interest are they willing to part with in order to partner with shareholders and those with additional equity interest. So an example of that, let's say bonds. A lot of folks I don't think are aware that bonds are effectively bills or debts. So it's effectively when a company says, hey, we want to raise money, but we don't want to give away any more of the company. So we're not going to increase, we're not going to add any more shares. We're not going to cash out. Let's go ahead and issue some bonds. And the bonds are basically like promissory notes or IOUs. And they say, hey, if you're willing to give me $1,000 for the next 5 years, I'm going to give you 5% payments every year, and then you'll get your $1,000 back at the end of 5 years. And that's, you almost could treat bonds as like the interest that you're being paid for you giving that money on loan to a company or whoever it is. The same is true with treasuries. I had to think of the right word for it. So treasuries, the difference is generally with bonds, you're working with companies. Treasuries, you're working with governments. So you're talking to the federal government of ours or another country, or you're talking with a local municipality or something like that. But it's the same idea. They're saying, hey, we would love to have you loan us money, and here's what we're willing to pay you to do it. So that's a layman's way of understanding bonds and treasuries and those sorts of things. So those are the two main ways of financing an organization.
So when a school district, when you see on voting things, sometimes they'll be putting out a bond issue.
Mm-hmm.
Who are they borrowing the money from? It's from the taxpayers, and who gets paid back?
It's a good question. The last few that I've looked at, they're generally run through the city. So I live in Mesa, and so I saw a couple of months back there was, Mesa School Unified School District or whatever it's called. Sorry, I should probably know that. But they're saying, hey, we want to issue bonds in the amount of X number of dollars for A, B, C, D, E, F, G. And effectively what they're doing is issuing the bond through the city government. So people could purchase Mesa City bonds or treasuries, and that would finance it. But the financing, the payments are going to go back to the people that purchased the treasuries or bonds. But there is also a cut of it that seems to go back to the city as well, basically for holding the debt. So if they say we're raising $100 million in bonds for the school district, I don't know what the actual percentage is, but you might say, hey, maybe 5% of that or some other number is going to the city for facilitating that exchange. Hopefully some of that made sense. Okay. Return on equity, that's another one, ROE. And again, these are all on income sheets, balance sheets, on their financial statements. Return on equity is just, hey, if I'm purchasing ownership interest in this company, what are they doing with that money? And so the other one that I like to put is right next to it is the debt to equity ratio. Is this company, are they primarily financing through bonds and loans and debt, or are they primarily financing through equity? There's benefits to both, but there's also trade-offs to both. If you're financing mostly through equity, the shareholders have a greater potential for reaping bigger profits if the company succeeds, whereas bonds, they're setting a fixed interest rate or a fixed payment. However, you may not be able to, if you're a new company starting out, you're not going to have any kind of a credit rating built up. And so people might say, hey, they're offering bonds, but I don't have any idea who Joe Schmo's coffee shack down the street is. And I don't even know if they'll be in business in 5 years. Why would I want to give them $1,000 if they're going to go bankrupt in 6 months? So you're having to look at different metrics in that regard. Okay, so we'll briefly jump off of stocks. We'll move very briefly onto bonds. So bonds are so heavily influenced by things like credit rating, and you'll see any bond that's offered on the public market. You can also find private placements. We're not going to really get into that because it gets really convoluted. So we're going to stick with public sectors right now because that's the easiest, and that's probably what most of us would get into. That's all I've ever worked with myself. So credit ratings, there's things known as junk bonds in the industry, really low credit ratings. They generally offer high percentage. You're like, oh, sweet, I can get 12% on this bond. But there's generally a higher risk of, hey, this company's not proven, they're not tested. Are they going to be in business to pay you back? I don't know. The better the credit rating gets, typically, the lower the yield or the percentage that they're offering gets, because they've built up a better credit rating. They've established that they have an idea what they're doing with their business. Maybe they've been around for 50 years and they're like, hey, we're looking to expand into a new market, in a new city. We're just going to try to raise a little bit of money to finance that. You may get a much smaller percentage rate, but then there's a very high probability that they'll pay you back. So the same again is true with treasuries. When they talked about several years back when the USA went from, I think it was AAA historically, and went down to AA. Is that right? Okay. Well, there was a credit knock for the first time like in the last century, and it was a big deal because now that means a couple of things. One, it means in general investors are less confident in the US government in terms of an investment perspective. And so now when the government tries to issue treasuries and bonds, they're having to bump up what they're willing to pay out to entice people to purchase it versus what they could do previously. So all of this stuff is linked together, just kind of being aware that their credit rating is important. Interest rates are really important when you're evaluating bonds, because rising rates result in falling prices and then vice versa. Falling interest rates result in rising prices in bonds. So that's just a thing to be mindful of. And then we'll briefly do a couple examples in fundamental analysis on real estate. But one thing I wanted to just touch on that's going to be beneficial for every analysis of any kind of an asset, whether that's paper, portfolio, real estate, stocks, bonds, etc. I would encourage at least once, maybe even periodically, maybe you do it quarterly or a couple of times a year, is just to do like a full-blown economic analysis. Okay, what's the country's economic outlook looking like, and spend some time diving into that. And then also get it more specific to, if you're looking at real estate, make it more specific to your own region or where you're looking at real estate. Say, hey, what's Arizona? What's Phoenix? What's Mesa? What is the economic outlook of this particular area that I'm looking in? And then, so some of these are very easy to say high level. Some of these are a little bit more specific to stocks and bonds. I would say with stocks or bonds, looking again very specifically at a given industry, and then also at a given sector, and then finally the company. So as you're doing your analyses, you never want to do it in an island, as they call it. You never want to be like, okay, I'm just looking at I'm going to look at Tesla stock. What's happening in the rest of the world? I don't know. But hey, I got Tesla. Okay, well, that's cool, but what if they're catching on fire? Or what, yeah, exactly. Or what if, hey, somewhere in like China where they're trying to do all these production plants, all of a sudden China's economy is crazy and they don't have enough people to pass permits and inspections on a timely manner, so that's going to delay the building of these certain plants. Oh, shoot, well, that might impact Tesla's near-term and short-term prospects. So starting to get a picture of what's going on in the world and in various economies specifically that are linked to the companies that you're evaluating. If you're looking at real estate, it's a little easier because you can just kind of look global, national, state, local, and then even neighborhood. So with that, let's talk briefly a few examples of fundamental analysis in real estate. So we already mentioned the first part, global, national, state, city, local. I'll say housing. Some of these, so if you're looking into real estate specifically, one of the best resources I could encourage, there's actually a website called citydata.com, I believe, city-data. And you can look up pretty much any city in the United States and get a mountain of information. So you can get all the information about demographics, about new home builds and sales or resales. You get all the information about average income in a given neighborhood or zip code, average rental prices, school districts and ratings, average house prices. What was that? And crime rate. Yep, that was on here. Crime rates, local amenities and interest. That might be something that you have to do independent from city data. If you're saying, hey, I want to purchase in Maryvale because prices are so low. Okay, let's consider why are prices so low there. There might be a reason that 10 miles west prices are 2 or 3 times more and crime rate is 10 or 20 times less. But also amenities. Years ago, I guess maybe 20 years ago, I would have thought that investing out in Queen Creek was probably a shady proposition because back then there wasn't really a lot out there. So why did you go to Queen Creek? Well, you went there because you got a house for cheap. And then you had to drive 20, 30 minutes to get to the grocery store and do all that stuff. Nowadays, it's not as bad because there's all sorts of amenities and there's grocery stores and there's like outdoor facilities for sports and gaming. So now it's a great place. But thinking about those, because when you analyze and you think about these things, when you're going to either resale it or if you're looking to try to make it a rental and encourage people to move there, you have to think about what's going to draw somebody to want to live or to purchase or to rent this property. You can't just say like, ooh, good deal, out 50 miles away from everything, sweet. Okay, what's the market of resale? There is one, but it's probably a very narrow market. So what would be the things that would draw people to an area? This doesn't apply to us a whole lot out here, but I would also include with your analysis natural disasters or the potential therein. If you're looking in areas that are on like 100-year floodplains, out here we have a lot of issues with like dust storms, we get the monsoons. But fortunately, we don't really get a lot of anything else. We don't get a lot of earthquakes, tornadoes, etc. But these could all be things that are worth evaluating, especially if you're looking in different markets for real estate. And then this one is a hard one to find. I've never found a great way of identifying this, but if you can, more power to you. I would say access to utilities and also the frequency of outages. So are you in a place where, man, the power grid is just solid? If there's ever an outage, it gets fixed within like 5 or 10 minutes. That's something to consider. If you're in a place where, hey, there's 2 power lines that run through the whole town, and if that ever gets jeopardized, you might be out of power for a couple of weeks. That could impact the profitability of your investment. So those are a few quick examples of fundamental analysis. Technical analysis is when you're going to start looking at things like trends, charts, graphs. You start looking at like price charts on stocks. You start looking at home prices or estimated values, comparables, or comps as they like to call them. When we're looking at stocks and bonds, you could again be looking at all sorts of things like trends. Is it generally going up? Are you getting a lot of ups and downs? Is it really volatile? Is it very smooth? You have things called moving averages that track the long-term trend and movement of given assets. So if you're saying, hey, I know generally this given stock, we'll say Coca-Cola. I'm going to pick on somebody different for a change. I've been using technology all day, so we'll say Coca-Cola. So say, hey, the last 200 days on average, they've been kind of at a steady increase. In the last 50 days, it's been a little bit better. And the last week or two, it's been dipping. Well, you can kind of look at it and you can map out, and most brokers, a lot of non-broker related charting tools are available as well. You can actually look up line charts or candlestick charts of a given stock to say, hey, the last 200 days, the last 50 days, and the last 9 days, whoa. But that's useful because you can look at, okay, historically over the last 200 days, every time Coca-Cola goes up, it goes up by about 5%. And every time it goes down by about 3% or 4%. And so you can say, hey, in the last 9 days, it's gone down about 4%. Oh, well, that might be giving me an indicator that there's a pretty good chance it's going to start resuming its current trend because it's oscillating in a general movement. Same thing when it's going downwards. You do have such a thing as sideways markets. Those ones are the most difficult. There's a lot of ways to make money on it, but I would say for simplicity's sake, maybe avoid those until you're more comfortable with looking at charts and you're familiar with how things move. So there's a lot of shorter term traders that'll say, hey, I know that it's going sideways in the market, but it's generally trending up and down about 2 to 3%. And I did this for a while with currencies where I would just say, hey, when it hits the bottom of the little oscillation, I'll buy it. And when it hits the top, I'll sell it. And then, just kind of playing the mean reversion, if you will, reverting to the mean. So there are ways to do it, but I would encourage you maybe save that until you're more comfortable and familiar with looking at charts and graphs and how to read them appropriately. Just a couple examples of technicals on real estate. These I would look into things like for investment properties, if you're looking at residential, which is classified as anything that's 4 units or smaller, those you're going to want to look at what's called a gross rents multiplier. So that's effectively your purchase price divided by the annual gross rents. So assuming this is a property that's already existing and not one that you're going to take and convert to rental, hey, I found a fourplex and they currently bring in $4,000 a month. Let's try to think of an easier number. Let's say $5,000 a month because that's $60,000 a year. And now I'm going to change the purchase price in my head for the example to be easier. So let's say the purchase price is $600,000 and their rents per year gross is $60,000. So their gross rents multiplier would be 10. 600 divided by 60 is 10. And generally when you're looking at lower numbers, lower gross rent multipliers, so if you're purchasing a home at $100,000 as a rental property, not a home, that would never happen. Let's say a fourplex in a really sketchy part of town, but the gross rent multiplier is like 20. Wow, I only spent $200,000 for this thing and they're putting $40,000 in rents. This is great. Well, it usually indicates that you're looking in Maryvale. You're looking at a place where there's sketchy beyond sketchy. Good luck if you can even get paid on it. When you look into super, super pristine, Beverly Hills type places, you're probably going to have rates that are a lot different. You'll have maybe like a gross rents multiplier of 15 or 20 or even 25, which means you're not getting a high rental out of compared to the purchase price, but there's also a higher probability that you're going to get paid on time, that there's some more security to it. So generally, if you're getting anywhere in that like 8 to 10% range, that's great. If you're above 12%, you're going to get lower payments and better security, and then vice versa on the lower end. If you're below 8%, I'd say be cautious. A very similar thing is used with commercial rentals. So if you're looking at like apartment buildings, you're looking at like office complexes, things like that. Those, they do the same thing, but they just use what's called a capitalization rate. It's a very similar process. Not going to get into it right now, but it's just a way of analyzing, hey, what should I expect from the rentals and the safety of this given asset? Okay. was thinking about it all week. I'm like, this is going to be one of the hardest talks I've ever given because there's like 10,000 hours worth of information to try to condense into one. So I apologize if it feels like we're going fast. I know we are, but I'm trying to go as slow as we can. Okay, so back to our notes here. When we're talking about finding and analyzing and selecting deals, so always run your fundamental analysis, which tells you what to buy. Always run your technical analysis that tells you when to buy and sell. And then here's some blanks for you. Number 3, establish proof of concept. Now, this is one that is so difficult, especially when you start reading and studying and learning and you start getting excited about the possibilities of like, wow, if this is real, like I could start making lots of money because I follow this certain chart pattern or these technical indicators in the market. And it's like, why does not everybody do this? It's so free, it's so easy. Well, there is such a thing that's wonderful to help overly ambitious people such as myself, which is known as paper trading. Most brokers are going to offer a virtual paper trading account where you can go through the process of actually selecting stocks and bonds and ETFs and things like that, but you're using fake money. And so if you lose big, you're not losing any real money. If you win big, you're not winning any real money. But it allows you to establish proof of concept. You say, hey, this seems like it should work very well, so let me try putting it into practice for 6 months. If I can prove that this strategy that seems like it's flawless, if I can prove over 6 months in paper trading that actually it is as good as it says it is, okay, you have proof of concept. Maybe it's time to move forward with real money. But my goodness, and this I'm saying this one to you as please learn the easy way. I did not. I'm like, paper trading, this is great. 2 days later, all right, it's time to make some real money. No proof of concept and lost money. Dang it. Yep. So proof of concept is so important if you want to avoid making a very expensive education like I did. I would also say, now this is harder to do, and this is where the term paper trading got its origination or origins. Origins is correct. Origins. I know how to talk good. It was the idea that back in the day, before you had all these nice virtual platforms, people would just take the newspaper that would have the daily, stock percentages, ups and downs, and they would trade from paper and say, okay, if I was following Coca-Cola and you track it out for several months and you're just kind of watching the chart, if I would have purchased it then, how would I have done? And you do the same analyses. Why am I buying it? Is this the right time? But establishing that concept. So the same is true even with real estate prospects. I would encourage you to run simulations and get pretty detailed with it. If you're thinking about doing a fix and flip, okay, well, you got to look at all your stuff. You got to figure out, okay, what's the price they're willing to sell it for? What are the comps in the neighborhood? What should I expect to be able to sell it for? What type of buyer am I targeting before I even put money into this? Because if the type of buyer I'm trying to sell to is not the type of buyer that's going to buy in this neighborhood, you're setting yourself up for failure. But then take it beyond that. Go ahead and start putting, and this is before you actually do a real estate deal, I'm saying start to evaluate ones that would be in the vein that you're interested in. Start to do paper simulations. Say, okay, if I was able to purchase this at this price, and then go out and start getting actual quotes and bids. What would it take to redo flooring on 1,400 square feet? What would it take? What would be a fair contingency if, there's a crack in the foundation or we found mold in the walls or something like that? Run simulations and try to get real numbers and bids as close as you can. And even if you just have to make phone calls to different contractors and say, I'm just gathering information right now, but if I was to redo my roofing and I've got clay tile roofing, roughly 1,500 square feet, could you give me a ballpark of what that would be? Try to get real numbers rather than just typing into Google, what's the average price in my neighborhood? Because every time I've done that, the price on Google is like 2 years outdated. And so you can say, yeah, it should only cost like $50 a foot to build a wall, while everybody in the industry is doing it for 120 bucks right now. So it's like, okay, well, the Google thing didn't help me at all, and that just frustrated me because I thought it was going to be this, but it's more than twice the cost. So that's why I would encourage going out and getting real numbers on as much as you can. And then, what else do we have here? Oh yeah, project real hours of labor and marketing. opening and closing. So if you're saying, hey, I want to fix and flip this in 60 days, okay, is that realistic? If I was able to close on it, May 1st, based off of those same contractors that I spoke with, they have like a 2-month backlog. They wouldn't even be able to start it until 60 days has passed. And then it would take them another 30 days to do the project. And then I'd probably need to clean up and do marketing and get ready to try to list the house for sale. So maybe 2 months is unrealistic. Maybe 4 months is more realistic. So trying to project as close to accurate as you can, as if you were purchasing the project. And running through the simulation, and as painful as it is, I would encourage doing that at least a couple of dozen times before you actually do a real one. It's painful, it's going to take so much time and energy, but by the time you actually pull the trigger, man alive, the amount of information, the amount of confidence that you're going to have going into it, the keenness of your eye to evaluate quickly, is this like a sweet deal or is this like oh gosh, I'm glad I didn't pull the trigger on that one. It's going to be the amount of money that it can save you and the amount of heartache it can save you, priceless. So good. Okay. Investors' quick reference checklist. Number 1, make a plan. We've all most likely heard it at some point or another. Those who fail to plan to fail. That is sadly very, very true. I do love Ecclesiastes 10:10, where it says, if the axe is dull and he does not sharpen its edge, then he must exert more strength. But wisdom has the advantage of giving success. Make a plan. Make a plan for reading, for studying, for learning. And this could be, you might start off and say, man, I'm like the most interested in just learning about stocks. So maybe for the next 6 to 12 months, everything that you're focusing on when it comes to your financial education is geared around stocks and company analyses. Or maybe for you, it's, hey, I really, really am just so interested in fix and flip real estate or in residential rentals. So you may start off with, that's your plan. I'm going to do this, and then write it out. Hey, 3 days a week, I'm going to spend 1 hour in the evenings reading on this subject, or whatever it is. And then adjust it over time. There might be seasons where you're like, holy cow, I can spend about 20 minutes a week and that's it. There's going to be seasons where you're like, man, I can read 3-4 hours a day on this stuff and it's really interesting, so go for it. You can adjust as you go. That's the point of setting a goal or a time budget. Is like every other budget, it's just to produce freedom, to move us in the direction we want to go. It's your budget, so you can modify it as you need to. I'm not going to set it for you. I'm not going to be checking up on you for it. But then also make a plan for each individual investment or deal opportunity. So again, if you're looking at a stock, make a plan for it. Okay, as I'm doing my analysis, what are the things that I want to be checking on? Okay, I want to be checking on the chart. I want to be checking on the sector, the industry, economic status. I want to be checking on the company's prospects. I want to do some research and find out what have they done in the last 5 years. What are they excited about right now and moving forward? And I'm going to spend time looking at their financial statements to see if everything's telling a unified story or if there's discrepancies or discord. There's a better word for it. Not harmony. What's the opposite of harmony? Chaos. That's a good word. There's a musical term for it, and I can't think of it right now. Dissonance. There we go. I knew I'd get there. It just took a minute. Chaos is also very good. So that was number 1, is make a plan. Number 2, analyze. Analyze every deal. Anything less is simply gambling. I've heard it said, you're noticing I'm putting a lot of emphasis on like how much work it takes to do this right way. In one of the books, and for the life of me, I can't remember who it was. I can't remember if it was, it might have been Peter Lynch, the famous hedge fund manager of the Magellan Fund. I think it was him, it might have been somebody else, but they said, investing, if done rightly, is one of the most boring things in life. If you're feeling like it should be really exciting, be careful. Now, we do like to make money, of course, but the process of going through all of our, detail by detail analyses and being intentional and focused and having a plan and sticking to the plan, by the time the expected profit happens, it should be like, okay, that was what I was expecting. It should be, it feels counterintuitive to say it, but it should be a very boring process. Number 3, exercise discipline. Oh, here you go. I got ahead of myself. Stick to the plan. Investing should be the most boring thing in your life. The plan may be modified as needed over time, but never modify it in the middle of a particular deal or opportunity. If you find yourself wanting to modify the plan in the middle, be careful. Ask yourself, why am I wanting to modify it? And again, in my own experience, everybody's is different. My own experience, anytime that I've personally have wanted to modify the plan in the middle of a deal, it's been for a bad motivation. It's not been, oh, wow, the prospects are actually way better than I expected now that I'm doing my analysis, or, oh, it's way worse than I had originally thought. It's usually like, oh, I bet I could get more out of that. And boom, dang it. And number 4, have someone hold you accountable. This is one that nobody ever wants to do, myself included, but by golly, it sure helps you be a lot less stupid. If you know that somebody's going to be looking at your plan and like, hey, were you sticking to the plan? Or maybe you even share some of your investment numbers with them. Have somebody hold you accountable. Did you do your analysis? Did you check all your boxes off? Oh, okay. Well, if they're going to be looking at it, I guess I actually should do the analysis, not just kind of pretend I did. It's very, very uncomfortable, and nobody likes to do it. But if we're willing to, it can save us a lot of hard times. Wisdom has the advantage of granting success. Well, there we go. The most technical and convoluted message of all time. Hopefully it was somewhat helpful. Katie, would you close us in prayer? Sharon? Okay.
Thank you, Father, for all that you do for us, for this time